Good morning. I guess we're still morning. Nice to see everybody. This is such an interesting panel. In our policy work here at the IIF, we've always had a focus on financial market risks, all the way from the Latin America and Asian debt crises, the great financial crisis, euro area crisis, and all the risks associated with that massive buildup in global debt over the past decade. And it's really that last topic that we're here to discuss today. And we called this panel, lower for longer for a reason. The question of whether low and negative rates are truly a new normal, it's neither here nor there, right? We're living with them now. Over 15% of global bonds trade at negative yields. And the ripple effects from this are really far-reaching through the banking sector, credit markets, emerging markets, the broader global economy. And we are really lucky to have a superb group of experts to take us through all of these questions today. So let's dive in. And Lisa, you are first up. We actually have done this a couple of times now. I remember discussing whether low rates were here to stay a couple of years ago, and you were right on that. But from the perspective of a major global investor, where are the risks building up? What are you most concerned about? Supply side effects of low rates.
Well, it's funny you started with all of the various crises that we've seen over the many decades, and I think that I have a very simple rule of thumb for a crisis, which is duration mismatch, leverage, and misaligned incentive structures. And so if you look out at the world today, we've had the GFC, we've regulated our financial institutions, we should be in good shape. And I think that the place that we're perhaps not looking because it's opaque and not very transparent has been the cross-currency markets. And so I think that the implementation of negative interest rates in Europe and Japan has created a dynamic in the cross-currency markets that maybe is underappreciated by market participants.
Maybe I could draw you out on that a little more for those who might not be familiar with these types of risks.
Well, if we look at, for example, the European banking system, and we look at the price to book, what the banking system there, those banks and the insurance companies are trading at, they are trading at distressed levels. And that is a result of the negative interest rates that have been implemented. The search for yield is sort of a natural result of that. And we've seen both the European and the Japanese investors search far and wide for that, whether it's emerging markets or the U.S. market, which has over the last decade been a very attractive market to explore and invest in. And so what we are seeing is the marginal buyer in many of the U.S. markets may be, in fact, a foreign buyer. And that is fine, so long as that foreign buyer continues to buy. But it is certainly something to keep our eye on.
Indeed. And Frederick, Lisa mentioned sort of banking sector risks and issues. And there's a very widespread perception that low and negative rates are just a huge deadweight on banks. You've been following the banking sector for many years now. How do you see it?
Thank you. Well, there is a well-established linkage between low interest rate, the flattening of the yield curve, and the pressure on net interest margins. It's fairly obvious if you consider that banks do maturity transformation, and that in certain countries you have low rates, which imply that deposits which are floored at 0% become problematic for the banking industry. Pressure on NIMs affects pressure on profitability, as NIMs are the primary source of revenue for the majority of the banking systems across the world.
So NIMs being the net interest margins here, the difference between what you can lend money for and the rate you get on deposits,
Now, what is somewhat surprising is that the banking sector, in fact, has been quite resilient to this environment. Profitability, in fact, has not reduced as you would expect it, and therefore you could raise the question, in fact, is there a problem? Is there an issue here? And the reality is that I think you need to consider the wider changes that are happening, both from a cyclical and structural point of view, to really understand the long-term implications. from a cyclical point of view, in addition to low for very, 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 very long, I mean, in Japan, we've had 10 years of low rates. EU has had 5 years of negative rates. The US is at a low point, almost a low point for 40 years. And so you have this environment where one of the potential options normally for the banking sector when you have pressures on margins would be to increase your lending volumes. However, we are entering into a lower growth environment. The EU is going to grow at less than 1% next year and has had a deficit of growth versus the US of about 70 basis points every year. You combine that with some of the structural changes which are happening, and the most, I think, prominent of which is really the road to digital transformation. The road, this implies that banks are going to be heavily investing for the foreseeable future to transform themselves. There are risks associated with that, and they will be affected by potentially new forms of competitions which will provide further margin compression. And then the last element, I think, which is extremely relevant in particular for the US sector, is that you need to incorporate into this the fragmentation of the banking sector. The largest 20 banks in the EU make up about 60% market share. That's 80% in the US. If you look around the world, the most profitable banking systems, such as Canada, Australia, Sweden, are those systems where you have a concentrated banking system. At the opposite of that, you look at Germany, which, and I don't want to pick on Germany, but it's an interesting example where you have the top 5 banks making up about 40% market share, cost to income ratio, which is a really good measure of efficiency, is very poor, above 80%. You combine that and you end up with a situation where, because you have saving banks owned by the public sector, cooperative banks, commercial banks, the return on assets of the banking system is about 20 basis points. Wow. That compares to about 40 basis points in the EU, about 1% in Asia Pacific, and 1.2% in the US. So clearly, the question I think ahead of us is, what is the banking sector going to be able to do to offset this very complicated environment?
That's a topic I would like to come back to a little later in the discussion, particularly on the financial regulatory environment. But maybe if we can stick here in these first scene-setting questions, Geert, maybe you can help us out here from a perspective at the coal face at a European bank. Are low and negative rates, are they really helping and stimulate the economy, stimulate demand? Any risk of, say, bubbles in the housing sector and so on?
Thank you, Sonia. And as a market practitioner, let's look back a little bit. So since 2014, the ECB's policy has been instrumental in avoiding fragmentation in the euro area and the recovery of the banking sector. The steps taken have prevented deflation and have created room and time for structural reform, both from a government perspective as well from a banking sector perspective. So we've bought time. It led to a cyclical upturn, which helped banks in keeping non-performing loans pretty low. It also bolstered credit demand. And if we have a growing sector, we have a way to grow ourselves out of the headwinds that we face. So slowly profitability returned and balance sheets have strengthened of the banking sector. But since the latest announcements in September this year, on balance, we believe no longer the benefits that the Eurozone has from this monetary policy outweigh the negative effects that start to materialize. Low rates at minus 50 basis points because the deposit facility, and then the longer end of the curve is really flattening out through the re-announcement or revitalization of the asset purchase program with 20 billion a month with an open end. led to a further flattening of the yield curve. And let me bring you into the secret of banks. We need a yield curve in order to effectively be quite profitable. So we believe this is the continuation of this negative rate environment and monetary policy is severely hampering the effectiveness of the monetary policy transmission. And if you want, I talk about that a little bit later. And by now, just like Frederick says, it starts to really hamper the profitability of banks. We have been able to postpone the effects by a multitude of measures that we have applied. But by now, it's about time we get a yield curve back. Otherwise, the profitability will be really hampered for the European banking system. One remark I want to make. So return on assets, return on equity, on average in the euro area banks is below 6%, where the cost of equity on average is above 12%. So price to book of European banks around 0.5 makes up the math, but it's not a healthy situation.
In itself a source of risks, yeah. So Nelly, maybe you can tie some of these threads together for us about the risks building up in a low-rate world. You've done some really fascinating work on GDP at risk, and how do you see these playing out and the consequences of credit bubbles?
So thank you. So been thinking about and doing some research on low for long, and I think one of the key takeaways is that what it does, low interest rates reflect a lower path of expected growth, but it also creates larger downside risks to growth over time. And this reflects, one, monetary policy has less space to move when you have low rates. So if interest rates are at 1 3/4 to 2%, they can only go down so far, at least using conventional policies. And then in an environment of low rates, this global reach for yield that Lisa talked about and others have talked about, that generates sort of incentives for risk-taking that get you either asset bubbles or debt accumulation that make a whole financial system much less resilient to any kind of negative shocks. And so that can generate much greater downside risk to growth than the potential for upside once you're in a low rate environment. So I think that is part of the underlying growth at risk. So it's saying there's financial stability risks that can get big. Monetary policy and financial regulatory policies need to work together, more importantly now, given these risks, and that's hard to do. Generally, you think about financial stability risks as risks to the banks, probability of a bank failing, but that's very difficult to translate to sort of a macro policymaker. Like, how do they think about the probability of a bank failing affecting GDP growth? So the work on GDP at risk, which is what it's being called right now, is about, can you translate risk to financial stability to downside risk to GDP growth? Like, really translate it to, is it the probability of a recession of 5% or 10 or 20 or 30%? And so the ideas, and the key insight is that when expected growth is low and expected to go down lower, the whole distribution of what your growth could look like changes. It shifts. Variance is not symmetric. You don't have equal up and equal downside when you're at low levels. And so the fact that you can get these downside risks is something that where we've been trying to make some progress, because it's very important that monetary policymakers be able to systematically incorporate risk to financial stability. And the only way to really do that is to think about it in terms of like the way they think about setting monetary policy, which is about GDP growth and inflation. So that's sort of the underlying views. Currently, I think the U.S. is at sort of what I would call an inflection point in terms of risk to financial stability and therefore GDP growth. One is monetary policy is starting to ease because of tensions, uncertainty with trade tensions and higher tariffs, and it needs to. The financial system and financial stability has not been, in my view, risks have not been that high. It's sort of counterbalanced. You've got high asset values, you've got a corporate sector that's very highly levered, but it's offset by banks that are very resilient, and even non-banks right now are probably, it's kind of building, but it's not there. But now there's a move to relax the financial regulations. And that seems to me like the exact wrong time to be doing a lot of relaxation of financial regulations when monetary policy is also easing. So in that sense, I think we may be kind of at an inflection point.
Can I add
Please,
to
go
that?
ahead.
I would just say, so, and again, a very simple model of this would be low for long, which I think is the beginning title of our session. So that low for long creates this dynamic, which is the search for yield, et cetera, asset price inflation or reflation. And I do think that the central banks get into a situation which is very difficult, because today we fast forward 10 years after the crisis, and we have a non-financial corporate debt that is quite elevated. We have asset prices that are quite strong. And the moment that the central banks begins to try to normalize policy, they find that they can't. And so I think that the easing that we've seen over the last half year is an indication that, I call it a corner solution, that we're a little bit in a corner solution, and it's very difficult to create that waxing and waning of policy that you've seen in typical cycles.
Which is exactly why financial regulations, ensuring the financial sector is resilient enough to sort of see these ups and downs of asset prices and shifts in debt and defaults is more important now. And it's all a function of sort of this lower for long kind of environment. There's less flexibility, less maneuverability of traditional policies.
Well, it does keep cropping up, and it's about the third or fourth time the financial regulation piece of it is creeping in here, even though, you're strictly speaking, the topic is more monetary policy focused. But Geert, I know this is an area that you have pretty strong views on the kind of dual functions of central banks in this regard. Do you want to share your thoughts here?
Indeed. So I understand in a loose monetary policy that loosening up regulation, it might not exactly be lead to the best outcome, but I believe that a profitable banking system is a prerequisite for financial stability. And if you see what the drag will be for European banks' profitability on the back of negative rates, if you combine that with the impact of, let's say, the normative capital requirements and the inflationary pressure on risk-weighted assets stemming from model reviews at the ECB, preceding Basel III impact, then I dare to say that in a low profitable banking environment, increasing regulatory burden is also not something I would wish for, because it simply aggravates the financial stable situation.
So, please,
Yeah,
Nelly.
and I think it's important to distinguish between European banks and the U.S. banks at this point. So U.S. banks are fairly profitable. Their price to book is above 1. I mean, it's as opposed to European banks. They're not facing the same interest rate configuration as some of the European banks.
And that's exactly what I was going to turn to Frederick about, because clearly you must be up very late at night worrying about these issues. But how do you see those different outlooks for U.S. and European banking sector, considering all of this?
When we compare and contrast the European banking system with the US banking system, we look at a number of different aspects. Certainly, the operating environment in terms of higher growth in the US, high interest rates, a different industry structure, more concentrated, naturally create an environment where margins are going to be more protected. And therefore, we have seen, in fact, over the past few years, a quite large, in fact, gap between the overall credit quality of the US sector versus the European banking sector. The European banking sector, on the other hand, has done tremendous progress over the last 10 years. I mean, there is no doubt if you look at where the banking sector was at the inception of the financial crisis and where we are today, capital metrics have improved very significantly, purely from a measure of capital, but including also leverage. Asset quality now, in fact, has returned to a more normalized level. Funding and liquidity also is of much better quality in terms of the lengthening of the maturity on the liability side. So all of this, in fact, implies that we are in a better position in terms of the overall quality of the European banking sector. But the gap with the US remains and will not naturally disappear. In terms of pure profitability, you have about 90 basis points of difference. Out of those 90, about 25 purely relate to the level of interest rates at which banks deposit their funds at the respective central banks. So if you take away that 25 basis points, you still have 65 basis points, which are difference really driven by the environment and the banking system structure. And we have, in fact, no expectation that this will narrow over time. Including if you were to go into fast forward 10 years and interest rates start to rise again, it's not obvious that the European banking sector would benefit as much as the US one, because again, the European banking sector is driven by overbanking, and overbanking then implies competitive pressures which limit the benefit of a potential interest rate change.
Sounds quite cyclical. Oh, go ahead.
So one thing that I think is another unintended consequence of ultra low or negative rates for a long period of time is that you allow organizations, whether it's banks or companies or take your pick, whatever you'd like to have, they do stay around. So, you know, the debate about are we becoming Japan? I mean, zombification is one of the big attributes that you never have actually clean, created that pause that refreshes or creative destruction. And my concern is that the concern of regulators has moved from financial stability to protect at all costs, everything at all times, and nothing should fail ever. And that's I think also damage. I think that's extremely damaging to the European financial system.
So Nelly, maybe you could say a few words here, thoughts on macroprudential policy in this context of ultra low rates and negative rates.
So I think, as I said, I think the downside risks to growth are greater when you operate in a low interest rate environment. So it's important, increases the importance of financial institutions being resilient, at least the most significantly important ones where the connections within the US and across the globe are. Macro-pru policies are more adopted in European countries and other countries. It's not that common in the US. I think in the US there's something called, there's a capital surcharge on the largest systemically important institutions. There's a little element of macro-pru in the stress tests that the US banks have, in the sense of they're designed to be that banks have enough capital after a large recession to continue lending to support the economy. You try to reduce the likelihood that in a big recession banks contract, reduce credit, and actually amplify any kind of credit downturn. But the use of countercyclical capital buffer, while all countries have that in place, that's one of the key macro-pru tools. The U.S. hasn't shown a big appetite for using it at this point. About 13 or 14 European countries have used this. And the idea is to, when times are expansionary, banking cost of equity capital is relatively less costly. It's all relative. You build your capital so that when the economy turns down, you have capital to absorb losses, and you can also release that capital requirement so that also banks all of a sudden have less of a regulatory constraint and then can continue to lend. Right now, it's all been on the upside, and it has not been tested on the downside yet, and I think that will be a key to the success of this kind of tool. The other macro-pru tool that might be relevant for the current discussion is whether you can put some kind of debt-to-income ratio or a loan-to-value ratio on borrowing. So the U.S. Bank supervisors in 2014 tried to impose a debt-to-income regulatory guidance on loans that banks made, on leverage loans. So if it was 6 times EBITDA, then that was viewed as a high-risk loan. That was issued as guidance. The Government Accountability Office determined that read like a rule, and so it should be a rule, which means the agencies would have to issue a rule, but then it would be subject to the Congressional Review Act. And Congress made pretty clear they didn't like these kinds of strict rules. So I think right now there's a little bit of this uncertain view about if banks originate these kinds of loans and they keep them on their books, supervisors can have some view on these, because if they pose risk to the banks because they're on their books, then supervisors have a say. If they make these loans and distribute them and put them into CLOs or wherever, the banks who originate they don't meet the same requirements for underwriting standards. So I think that's one of the key issues that some people worry about is, are we going back to an old originate to distribute model? And so I think that's kind of where it is in terms of policies. And it's a balance of how strict you want, you don't want a world where there's no credit risk and no risk taking, and but how do you assess, what are the future risks from weaker underwriting standards that are distributed into the markets?
Geert, may I bring you back into the conversation here? We've been talking a little bit about potential buildup of risks, and of course it's the job of regulators to set the balance on, supporting growth and keeping risk. What's your feeling about whether low and negative rates in a European context have led to much of a buildup in risks on bank balance sheets? And, do the regulatory tools need any kind of adjustment at this point, in your view?
Yeah, so the ultra low or loose monetary policy ultimately leads to financial asset inflation, and I don't believe we are sufficiently rewarded for the risk that we are taking on our balance sheets. But if you look at the size of the European Central Bank's balance sheet, due to the fact of quantitative easing, European banks have which was already a highly competitive landscape. With the ECB buying, they've got the biggest competitor in the market. Now, this obviously trickles through the whole stack of credit, and ultimately leveraged loans are currently close to a multiplier of 8, and there's huge demand. And if you see what the risk return is, I'm glad we stay away from those leverage loans today. So it's clearly leading to more risky profiles without being rewarded for it. But if you look at the ultimate impact of Basel III in the end stage, then you actually see that relatively low-dense RWA banks, so maybe high leverage but low risk dense, are forced to reduce the leverage, but actually to increase the risk weighting density in order to make up for the capital used. This is a perverse side effect of the Basel III rules. So look at, for instance, Dutch mortgages. They have a very, very low risk profile. Through a cyclical crisis that we went through since 2008, the risk profile remained very subdued. But the capital increase due to model reviews, Basel, and cyclical measures has almost been doubled, while the risk hasn't changed. So, yeah, if you, as a bank, need to show decent returns to your stakeholders, you start to move into more risky assets at a higher spread. And personally, I think that is a side effect, unintended, of Basel, and it should be reviewed, clearly.
So,
Sonia, maybe just
of
adding
course.
something on how risk is building up or not building up in certain sectors. We obviously look very closely at property-related risk, related risk. We all have experienced the close correlation between property bubbles and the impact on the banking sector. But as we look at that more closely, I think we see that really the inflection point was around 2016, early 2016, where you started to see build-up of property prices in certain European countries. For some of them, it's taken a longer period of time, but a good example of that is certainly Ireland, which has moved up by about 40%, although on the back of obviously a very negative cycle before that. But when we think about those markets, we also look at obviously affordability, which is extraordinarily low. Right now, you can take a 20-year fixed mortgage in France for 1.20% per year. That's extraordinary. I mean, everybody should take one. It's a wonderful opportunity.
I'm in.
And then the next step is really to consider, have we seen a growth in household indebtedness? And there, in fact, the metrics are, at this stage, more favorable than one could expect. In fact, if you look at private debt to GDP over the past 3 years, it's been relatively stable for most countries. Some have seen a little bit of a greater push. France is a good example again. But in general, it's been relatively stable. So to some extent, I think the question with that market is more about what would happen if you do see an interest rate shock. That's probably the greatest risk, but that's more of a longer-term concern than a more immediate one.
I think everybody's just putting that on the back burner, right? I mean, if along with low rates is low inflation, and then no one is predicting any kind of interest rate shock, and it's really interesting because this can all persist, for a very long time, unless you have an expectation that rates are going up. But I wanted to pivot here a little bit to something that Geert had raised, and that is the kind of leverage loans and CLOs and sort of high yield markets. And Lisa, maybe you can share your thoughts on risks here and who is the marginal funder in this area and how will these risks play out?
Yeah, and I think not a specific asset class, but I think the question is, what are the incentive structures that are driving flows? And so if we look at the non-financial corporate sector here in the United States, we're more levered than we've ever been, quite substantially. We've enjoyed quite easy funding standards. Credit spreads are still very, very favorable. Rates obviously are extremely low. And that has been a very positive environment for the U.S. corporate sector. But I do worry that our friends abroad are part of the reason we've enjoyed such friendly credit standards. So that would be what I would be worried about.
Inappropriately low rates in the U.S. because of low rates elsewhere in credit standards.
Yeah, and I think inappropriately low. I think the U.S. Part of the reason why the U.S. has been enjoying, a positive flow environment is because we've been much more competitive versus the rest of world. So is it inappropriately low right now here in the United States? I don't know what the answer is, but I also would argue that coming back to the European experience and the Japanese experience, those ultra low or negative rates, I don't think actually created the environment that the policymakers were hoping for. So, fundamentally, what is the thesis behind these rates is that it will spur consumption. And I think some of the models that were used to make that argument were models that were built on populations where the median age was, I don't know, take your pick, maybe 30, something like that. When your median age is getting up into that point in your life cycle where you're thinking about your retirement income and your retirement spending profile, it has not been stimulative. So if you look at the German household savings rate, it has absolutely skyrocketed. The Germans are not going out and buying more stuff. They are actually saving more in response to these extremely low rates. So I think I get worried when I hear people blithely talking about negative rates here in the United States as if this would be a solution to a growth problem. I don't actually think it's a solution to a growth problem. I think it's devastating to your financial system, and it doesn't achieve what you're hoping for in the long run.
Geert, did you want to comment?
If you look at what happened 3 decades ago in Japan and what happened to the capital of Japanese investors that went all overseas, the domestic business of Japanese banks runs at a net interest margin of 20 basis points, just enough to cover the local OPEX. But they have expanded substantially over the last 30 years overseas, including into the US. In Europe, you're heading into the same direction, and if you listen to the C-suite discussions or peer-to-peer meetings in the last couple of days, you hear European CEOs of banks clearly saying that they will probably deploy more capital outside of the Eurozone, which will then ultimately be followed by others, and then it will lead to an asset mispricing of assets outside of the Eurozone, and that's where you end up with these highly levered loans. And I agree, this is more a threat to the financial stability rather than an opportunity to boost consumption. If I may, the biggest problem sits, the consumption ultimately comes from the consumers and not from the corporations. So if banks in Europe are unable to pass on the zero lower bound of the interest rates to their clients, then the banks absorb the difference between 0 and -50. Today, there is no credit demand unmet by anyone in Europe by banks. We provide the credit at the standards, so that's not like there's a over demand and not sufficient supply. But the problem of not being able to or not being willing to go into the unprecedented experience of client behavior if you actually charge clients for holding their cash means that on the asset side we also do not pass on the low rates to the borrowers. So that 50 basis points we absorb ourselves, but we also try and let our borrowers pay for that. And therefore the monetary policy transmission mechanism today is broken. It stops there, and then global capital flows will lead to the asset inflation that we see of highly liquid or professional assets. But the people in the street are suffering from this monetary policy.
Just on the topic of deposit rates being floored at 0% for retail consumers, we are starting to see some signals that certain banks are now considering applying negative deposit rates to retail customers. Initially, the discussions are more about those customers that have deposits in excess of the guaranteed portion, which is in the EU 100,000 euros. But going beyond that and really considering the full deposit account as being subject to negative rates is obviously a very political question. It's a very difficult one to impose, where banks are still viewed in many banking systems as an evil and therefore should be taxed. One way that banks will probably consider this as an alternative way, which is probably less visible, is by considering how they charge for current account and adding fees to current account as a way at least to mimic having negative deposit rates. That's quite likely the direction we're going to see going forward.
But again, and I don't think you're disagreeing with me, but it's insanity. It's complete insanity that the view is that this is a stimulative policy. That is still the view of maybe not the people in this room, but that this is viewed as a stimulative policy. And sure, that, asset prices, they do go up, QE, negative rates, all of that. Yes, we do enjoy an appreciation of all our asset prices, but I don't see the man on the street benefiting.
So I would just emphasize it. The reason I think the U.S. is at what I would call an inflection point now is exactly for this reason. Interest rates are at Fed funds or repo rates 1.75% to 2%. It's not negative. Getting to a negative outcome would be, I'll use Lisa's words, insanity. So at this point, what you want to do is make sure the economy, the financial system, is resilient enough to absorb these kinds of typical shocks that could come along and you can't predict. And so that monetary policy can still have a little room to work. If you end up with a really severe financial hit and a recession and monetary policy has to go to zero or negative, it's probably a worse outcome for you in the long run, or in the next few years than if you could maintain a financial system so the monetary policy still has some room to work in the positive zone. I think just non-conventional policies are just less stimulative than conventional monetary policy.
If one were to sort of, summarize some of the themes that we've been talking about, it kind of feels like what you're saying is we are not at the brink of some imminent acute crisis related to a buildup of risks to do with low and negative rates, but rather that the long-term consequences of this are much more worrying. So perhaps people want to comment a little bit about some of the longer-term structural factors, like demographics have come up, and go ahead.
And I think with financial risk, I think that I would push back on that conclusion a little bit. And I think that it's something that you watch and you worry. I don't think it's something that we think is imminent, but I do think it is very interesting that, we've had some treasury auctions in August that didn't seem to go particularly well. We've had some interesting things happening in the repo markets. I think that's something we should be watching. I
could potentially be systemic, you're thinking.
I think that you just have to, not be complacent.
The glass is not half full. Yeah. Again, turning to the sort of, Japan, aging societies type issues. Nellie, I wanted to kind of ask you to look into a crystal ball a little bit. Are we facing low rates, not just for longer, but, indefinitely? And what are the kind of growth consequences of that?
So I think just demographics themselves gets you a lower rate. There's the potential for to improve productivity that I think with fiscal policy trying to make investments that can increase productivity, that can offset a little bit of the decline in the rates, it feels like that would be a productive use of resources if one could take a total social planner point of view. I'm not. I think the demographics in the U.S. Well, a lot will depend on immigration policies, but are a little more growth positive than they had been in Japan. I'm not as pessimistic about that, but I do think we have shifted to a lower R-star. How low it is, I think there's uncertainty, and I think it's something you can actually try to do something about. You may not be able to fix demographics very quickly, but you can fix some other things. And so it's lower, but it doesn't necessarily have to be really low. I think it's.
So did you want to comment?
No, I was thinking that obviously there is a demographics do support low for long, but there is maybe a silver lining which is coming from a completely different angle. And in fact, we discussed that briefly before coming into this room. And it is to what extent climate change will create a significant opportunity for the banking sector in terms of creating new demand. Yeah. And that could be obviously a game changer over the next decade.
Yeah, not the opportunity side of it as well as the risk. That's a topic we just discussed on a previous panel as well. So, this has been really thoughtful. I wonder if next year, the 2020 iteration of this is going to have the same title, or whether we'll be able to amend it in any way. But thank you very much for a wonderful discussion. Thank you.